Welcome to this event. Thank you so much to those who are joining on the live stream. Thanks also to everyone who will watch the video of this event at a later time at their convenience. I'm Michael Strain. I'm an economist and senior fellow here at the American Enterprise Institute. I'm delighted to welcome you to this event on such an important and timely topic with inflation being in the news everywhere and affecting the lives of everyone who's watching. What explains the growth of consumer prices over time? One prominent theory suggests that inflation is determined by changes in the supply of and demand for money. As Milton Friedman famously noted, inflation is always and everywhere a monetary phenomenon. Other economists would turn to Keynes and argue that inflation occurs when aggregate supply falls or when aggregate demand increases. Many economists believe that the Fed has control of inflation by affecting aggregate demand. For example, an economist might model inflation as being equal to deviations of the short-term policy interest rate from the neutral interest rate and deviations of the unemployment rate from the full employment rate of unemployment. Still, other economists argue for the role of psychology in determining inflation. The behavior of prices today, in this view, is heavily affected by what consumers and market participants expect the behavior of prices will be in the future. And many more economists still blend elements of all of these distinct theories together when thinking about inflation. Into this debate steps John Cochrane and his landmark new book, The Fiscal Theory of the Price Level. I have a copy of the book right here. Cochrane stresses the role of government debt and expected future tax payments in determining inflation. In Cochrane's models, the price level adjusts to allow the real value of government debt to equal the present value of primary budget surpluses. US dollars are inherently valuable in this framework because they are what the government accepts as payments for taxes. Dr. Cochrane's book is extremely ambitious, and he delivers on that ambition. It is a landmark intellectual achievement. It is very easy for economists to ask big questions. It is very hard for economists to deliver satisfying answers to those questions. Even if John's argument hasn't convinced you, it will certainly leave you thinking, which is perhaps the best that we can do. The purpose of this event this afternoon is to explore Dr. Cochrane's book and his ideas. The run of show for this event will be straightforward. John will take 20 minutes or so to describe his book. After that, we will have responses from Robert Barrow, Eric Leeper, and Thomas Sargent. Following those responses, we will have a discussion amongst the panelists, which will be followed by questions from the audience. To submit your question, please email my colleague, John Toohey. His email address is john.toohey@aei.org. You can find the spelling for that on the event webpage. You're also welcome to submit questions via Twitter using the hashtag AskAEIEcon. That's hashtag AskAEIEcon. Now I will offer brief introductions. I'm very pleased to introduce such a distinguished panel of macroeconomists. To paraphrase President Kennedy, I don't think there has been as much macroeconomic talent on one stage ever, with the possible exception of when Adam Smith lectured alone. Robert Barrow is my colleague at the American Enterprise Institute, where he is non-resident senior fellow. Robert is concurrently Paul M. Warburg Professor of Economics at Harvard. Eric Leeper is the Paul Goodloe McIntyre Professor in Economics at the University of Virginia, Director of the Virginia Center for Economic Policy at the University of Virginia, an external advisor to the Swedish Central Bank, and a member of the Research Council of the Bundesbank. Thomas Sargent is William R. Berkeley Professor of Economics and Business at New York University and Senior Fellow at the Hoover Institution. He was awarded the 2011 Nobel Prize in Economics. And of course, John Cochrane is the Rosemarie and Jack Anderson Senior Fellow at the Hoover Institution. Let me thank all our panelists again for being here. Let me thank especially our audience for being here, those of you who are here now, those of you who will watch the video later. And with that, I'll turn it over to John for his presentation about his research and his ideas.
Well, thanks for that nice introduction. Thanks everybody for coming. Thanks especially to my esteemed fellow panelists. So my contribution here is I have a book and also extra material, which you can find on my website. A lot of what I'll talk about today is drawn from an essay called Fiscal Histories. So what is this fiscal theory of the price level? And as Michael nicely put it, we start from one simple idea the price level adjusts so that the real value of government debt equals the present value of primary government surpluses, which pay back that debt. It's just like the stock prices adjust so that the price equals the present value of dividends. And the mechanism's fairly straightforward, like stocks. If we're holding on to nominal debt and it's more than we expect our government to repay, we try to get rid of it. And the only way to get rid of it is to try to spend it, and that drives prices up. And the bottom line, something Robert mentioned long ago, if people think of government debt as a good savings instrument, they hold on to it. If they don't think of it as a good savings instrument, they try to get rid of it, and that's what drives inflation up. Easy idea. Now, this is not a tight link between today's deficits or the absence of deficits or today's debt and inflation. Governments frequently borrow, and when they credibly promise repayment from that borrowing, that doesn't cause inflation. That's my first little graph on the left there. If you have big deficits, but people think they'll pay it off, that does not cause inflation. So there is not a quick deficits to inflation, debt to inflation, and vice versa. It's all about if you have deficits today and people don't think they'll be paid back, that's what causes inflation. And even if there's nothing happening today, if people lose faith in the future, then that can cause inflation that comes with no particular news today. Expectation seems kind of nebulous. No, the vision is not that Joe and Jane sit around their kitchen table and forecast the budget deficit in 2035. Expectations are really implemented by institutions, rules, norms, regimes. Do we have faith that sooner or later Washington will figure out how to repay the debt, or do we lose that faith? That's what it's about. And the theory is fundamentally the question, what is the nominal anchor? There's all sorts of things that Michael mentioned earlier, psychology, dynamics, and so forth. But underlying it, there's a nominal anchor. What sets the overall level of prices in the long run? That's what fiscal theory does. It's a foundation, part of a bigger model, not a model by itself. To bring it to the world, we need to add interest rate targets. So that's fiscal theory with interest rate targets. We add a second thought. The nominal interest rate is equal to the real interest rate plus expected inflation. The Fed sets the nominal interest rate. So the vision is not just fiscal policy. The Fed is very important, and the interest rate target together with fiscal policy is what determines inflation. Roughly, the fiscal policy is in charge of the unexpected part, and monetary policy the expected part. This makes a prediction. Inflation is stable, no spirals. It is determinate. The model gives you one answer. In the long run, it's neutral. Higher interest rates have to mean higher inflation. And in that way, we finally have a full theory of inflation with interest rate targets. Well, what about money? I've got Milton Friedman here and his license plate, MV equals PY. Cash and reserves are a form of government debt. So I agree with monetarists. If you drop $5 trillion from helicopters, you'll get inflation. The question is, what if we drop $5 trillion from helicopters, but take back $5 trillion of treasury bonds? So you have no additional wealth overall. It's just in slightly uncomfortable form. Well, that's the question. Does that obviously cause you to go out to spend? Not so obvious. But we don't really even have to fight about theory. In our world, the Fed sets interest rates. The Fed does not control the money supply. MV equals PY. Monetarism only determines the price level if the Fed controls the money supply, and they don't do it anymore. We also have a vast amount of liquid assets. Money and bonds are pretty good substitutes these days. So MV equals PY is logically correct, but the real problem is it doesn't apply to today's economy with no control of money supply and interest rate targets. Fiscal theory of the price level with an interest rate target does at least work in today's economy. Let's explain what it is a little bit just by looking at history. First historical episode that I think is very revealing is the long, quiet zero bound. This is 2008. Inflation came out deflation showed up a little bit. Lots of people said, oh no, here comes the deflation spiral. It did not happen. Inflation just batted around the 2% target without doing much, the whole time interest rates were stuck at zero. Well, how do various theories talk about this event? The conventional wisdom, inflation is unstable, like our seal here holding a ball on its nose, unless the Fed moves very quickly. And that conventional theory makes a clear prediction. When you hit the zero bound, there will be a deflationary spiral. The new Keynesian models make a different prediction. When we're stuck at the zero bound, inflation is still stable, like Professor Calculus here illustrates stability, but it's indeterminate. There are sunspots, multiple equilibria, and inflation will be volatile at the zero bound. Monetarists made a clear prediction. Immense QE should have sparked a big inflation. The fiscal theory says, again, inflation is stable, determinate, and quiet at the zero lower bound, despite any amount of quantitative easing, as long as there's no fiscal shocks, no big bad news about fiscal policy. So at least it's consistent with that episode. And in particular, a big deflation spiral in 2008 would have needed Congress to pass a big tax hike to validate a windfall for bondholders who are going to get paid back in better money. No one expects that to happen, and that's why it didn't happen. Now, model. What happens if we drop a lot of money on people? A helicopter drop. Here's a simulation from a fiscal theory model. It's fiscal theory, sticky prices, and an interest rate target. We drop 1% of GDP from helicopters. The Fed does nothing with interest rates. That's what's going on here. What happens? Well, here's inflation, and there's the price level, the cumulative part of inflation. What does it say? We will slowly inflate away the debt, not instantly, slowly, over a period of years. This inflation, higher than the interest rate, inflates away the value of the debt to pay for that fiscal shock, the dropped money from helicopters, together with no plan to pay it back, until the price level rises, devaluing that government debt. Well, that seems reasonable. Notice, though, that inflation here goes away, even though the Fed does nothing, eventually, as long as there are no additional fiscal shocks. And again, that illustrates the principle. Inflation's stable, no spirals, determinate, no sunspots, contra the Stanford view. Standard view, not the Stanford view, that's for sure. Now, that's a nice theoretical exercise. What happened in reality? Here's current events. During the pandemic, our government did drop money from helicopters. $5 trillion, $3 trillion of it printed, $2 trillion borrowed, sent to people as checks with not much in the way of promises or plan to how to pay it back. In one of the luckiest strokes ever to happen to an economist, I sent the drafts of Fiscal Theory of the Price Level to Princeton University Press right here. And promptly, we got exactly what that theory predicts: inflation. To remind you, here's the model response. What happens if you drop $5 trillion on people? You get a protracted period of inflation, even though the Fed does nothing. And in the dashed lines here, just to make it more realistic, this is inflation measured year over year, whereas the model has instantaneous inflation. Second thing, that inflation broke out, just like it, at least the theory suggests. The Fed did nothing. And conventional view says, well, if the Fed does nothing while inflation breaks out, first of all, it's not always and everywhere monetary. The Fed didn't do anything. But that should cause an inflation spiral. Interest rates are below inflation. Inflation should spiral out. The fiscal theory model says no. It'll eventually go away once we inflate away that debt, so long as there's no fiscal shock. And that seemed to be about what happened. Well, finally, the Fed started raising interest rates. What is the effect of interest rate rises? Well, the model can talk about that too. Here's the second model simulation. And these are two basic parables. How does a fiscal theorist think about the world with interest rate targets and sticky prices? In this simulation, there's no change in fiscal policy. Instead, the Fed raises interest rates 1%. This is the blue dashed line, and leaves the interest rates high forever. What happens if the Fed raises interest rates? The Fed still has an effect on inflation. Here is inflation. In the long run, inflation goes up. This is uncomfortable, but it's logically inescapable. If inflation is stable and determinate and long run neutral, higher interest rates eventually, 6, 7, 8, 9, 10 years, must raise inflation. But in the short run, it lowers inflation. And in the short run, this looks pretty much like everybody's idea of what happens when the Fed raises interest rates. Inflation goes down, output goes down, asterisk inflation goes up in the long run. Now, the mechanism here is not your grandfather's ISLM curve by a long shot. The mechanism here is an interest rate version of what Tom called unpleasant arithmetic. By raising inflation in the long run, the Fed can lower inflation in the short run. That's an interesting mechanism. And I think we need a better model, but this shows, I think, what fundamentally the theory does. The central bank can lower inflation in the short run, but it cannot completely offset that fiscal shock. If there's a fiscal shock, debt that won't be paid back, that has to eventually inflate away debt. Now, the Fed can and should, and suppose we had the fiscal shock, suppose this happened, causing inflation. The Fed isn't powerless. It can add this response. It can say, well, let's raise interest rates, lower inflation in the long run. Yes, with a slight increase in inflation in the long run. That's a great idea. And in fact, the Taylor rule works quite well in this model, that the Fed should react to inflation, fiscal inflation, by raising interest rates and therefore smooth out the path of inflation, which is, I think, roughly what we're seeing now. So that leads me to think a little bit about the future and big picture. What I'm trying to show here is how the fiscal theory can help us to organize our thoughts about where inflation comes from and where it goes. The Fed's starting to raise interest rates, so add those two graphs together. What are we going to get? The moderation, even though interest rates stay below the inflation, but then because of this long run effect, possibly leading to a fairly stubborn higher level of inflation, roughly 1975, until the next shock comes, and always another shock comes. It does also point, though, fiscal thinking points to our future. We need to think hard about monetary fiscal coordination. These are two parts of a policy that need to work together. And it's going to be much harder this time. If the Fed raises rates 1%, we have $30 trillion of debt. That means the deficit goes up by $300 billion. Who pays that? If the Fed induces a recession, fiscal policy will want bailout and stimulus. Who pays that? Without these if fiscal policy doesn't tighten to pay these extra costs, then we have more of what just got us in trouble in the first place. And monetary policy without fiscal help can at least be much, much less effective, if not ineffective at all. And then, of course, comes the next shock. My worries are the next recession, war, financial crisis. Uncle Sam says, I need another $5-10 trillion. And look what happened in the $5-10 trillion we just printed up and handed out. That could lead to big problems. And then, as we all know, here's the CBO forecasts. And even those forecasts are an if nothing bad happens forecasts. Now, this is a projection, not a forecast. And the CBO keeps saying, we don't think this will happen. We think Washington needs to change. And markets evidently expect things to change. That's why we don't have huge inflation right now. But it does point to this sort of loss of faith, interest cost spiral, big effect of bad news. That is a danger. How do we get out of inflation last time? Last history slide. 1980s is supposed to be, it's the paradigm story for how monetary policy came and rescued us from inflation. And it's also a paradigm story of how the US at least got out of serious inflation last time. Now, the history of the 1970s and 1980s is quite interesting. Notice in the 70s, the Fed was raising interest rates and inflation came down even without on its own for a little while. Here's what I worry about sort of the current moment. Inflation can come down and then get stuck. But then in 1980, interest rates went very high and inflation went down and stayed down forever. Forever until 2021. But there's fiscal policy. This was not just monetary policy. Fiscal policy was there in the 1980 stabilization, as especially Tom emphasizes it always has to be. Two things you can see right from the graph. In the 1980s, interest costs on the debt, the difference between the Fed funds and the CPI, the real interest rates that the government had to pay on the debt, went way, way up, from next to nothing to several percentage points. Who paid those extra interest costs? Second, bondholders who bought debt at 15, 20% in 1980 got paid off in much more valuable dollars than they expected. Who paid for that? Answer, taxpayers paid for that. And here are the facts. Here's the surplus to GDP ratio. Yes, primary surpluses, that's what counts, not overall surpluses. And I graph unemployment so you can see one of the major things that happens is, of course, in recessions, we run deficits. So to think about long runs, you have to correct for recessions, which I'll let your eyeball do here. But this does show you how there was a fiscal part of the 1980s. Starting in 1980, here's 1980, the Reagan deficits were not nearly so bad as people keep saying. A lot of that was higher interest costs on the debt. And then the economy turned to massive surpluses like we haven't seen in a long time. In fact, the present value of surpluses did break trend, went positive, and repaid all that debt. Who paid for the higher interest costs? Who paid for the bondholder windfall? Taxpayers paid for it. And if they had not done so, it's likely it would have failed as it did in Latin America. Now, some of that was policy. We can point to tax reform, Social Security reform, which really helped on long-run deficits. I like to point to deregulation, or it might have just been plain good luck. But most of this was economic growth took off, and that's what paid it back. But it did pay it back. It was a joint fiscal monetary reform, which led to stabilization. And I think that's probably what we're going to have to do this time as well. Those are my comments. Let me briefly introduce my fellow panelists. In this work, I have truly stood on the shoulders of giants, and I'm humbled to have such wonderful giants with me here today. So here's my chance to embarrass them slightly, but also to introduce you to these giants and how much they have done in this question. Robert Barrow is, of course, famous for so many things, but the one I'll mention is Ricardian equivalence, his theorem in the late 1970s, that if people look at increased debt, but they expect future taxes to pay off that debt has no stimulus or inflation. And that happens most of the time. Robert also pointed out tax smoothing. Debt is a good thing. Borrowing and promising to pay it back without inflation is a very important way that we should run a government and how we should adapt to temporary problems. But we shouldn't run those deficits forever and ever. Tom is famous for so many things, but in this context, his unpleasant monetarist arithmetic, ends of inflation, and other essays set the foundation for monetary fiscal interactions. And the fiscal theory of the price level is a generalization of Tom's work, but it is a generalization of Tom's work. Tom also has been fantastic on using fiscal and monetary theory to understand history and current events. And I recommend his US Then, Europe Now Nobel Prize lecture. He figured out what they should have given him the prize for, and that was it. Eric is the third giant of the fiscal theory. His paper on active and passive policies brought forth the modern fiscal theory of the price level. And the difference there is that Eric gave us a theory of inflation with interest rates, not money. That's one of the most important features of fiscal theory. Our Fed sets interest rates. You need a theory of inflation based on interest rates, not money supplies. And he gave us that theory, including nominal debt, not real debt. And technically, Eric's work integrated fiscal theory with the kinds of models, New Keynesian, DSGE, whatever you want to call them, that are what macroeconomists use in today's era to think about the economy. So it becomes fiscal theory becomes a way of using and fixing those models, that theoretical apparatus, rather than some crazy thing that you have to do completely differently. And that is, of course, vitally important. So with that introduction, I'm just incredibly humbled to have the three of you here, and I will now shut up and listen to what you have to say.
Yes, John, thank you so much. And why don't we begin with Robert Barrow?
So the surge of inflation that accompanied the vast fiscal transfers associated with COVID, I think is behind the dramatic increase in interest in the fiscal theory of the price level, particularly among general economists. John's book covers and extends his mega contributions to this field, which really go back more than 20 years now. This is work that builds on contributions by Mike Woodford and a number of other economists. Although John's past and continuing work in this field is of great importance, I found it ironic that, as he already mentioned, because of the timing of publication, there is little material in the book on the COVID inflation that will likely move the fiscal theory into the status of general and lasting interest for most economists. In this sense, the COVID shock is for the fiscal theory of the price level, as the Volcker disinflation and recession is for the Phillips curve in the New Keynesian model. I think John's main conceptual contribution to the fiscal theory is within a frictionless model, which is what he starts with in his book. An adverse fiscal shock, such as a surge in current or expected future government spending, if not funded by a corresponding change in the present value of expected future real primary surpluses, has to be balanced by a decline in the real value of the existing nominal public debt. Of course, this could be accomplished by some kind of formal default on part of the debt, but instead of that, the typical change is a rise in the price level, which reduces the real value of the outstanding nominal obligations. And if you have debt of infinitesimal maturity, there's a unique response. The price level basically jumps instantaneously and is uniquely determined. So an important extension in the book, which stays within the frictionless model, is to allow for a distribution of government bond maturities. Then the initial condition specifies not just a total nominal amount of government debt outstanding, but also where the payments do arise in the present and an array of future periods. In that case, if you have unexpected changes in the price level today and also at future dates, you get an array of partial defaults on that outstanding distribution of the debt. And the total change in that present value is pinned down, but the precise distribution of when the price level is going to be changing and when there's going to be associated surprise inflation seems to me not to really be pinned down. It seems that you need some kind of initial additional considerations, which John has already referred to, I think. For example, a monetary policy that achieves a desired smooth path of inflation in a transition. You need something like that to pin down the full equilibrium for the time path of the price level in response to a fiscal shock. As far as I can see, you need that kind of additional consideration. So a key variable in this analysis is expectations about future funding through real primary surpluses. There's a recent paper, which is R&R at the QJE by Bianchi, Fassini, and Molosi, that stresses the major difference between fiscal shocks balanced by changes in future real primary surpluses versus those that are not. But the assumption in their framework is that people somehow know at the outset how much is going to be funded and how much is not going to be funded in that sense. And in reality, learning about this division and having some kind of path of changing expectations related to that learning seems to be central. And that, in fact, is the main object of study in another paper that's R&R at the QGE, which is by Bassetto and Miller. So an important point in their analysis is that agents are not motivated to spend much resources to learn about future fiscal primary surpluses when the government is far away from the binding constraint of not having enough future real tax revenue available or not having available future spending cuts to use to achieve changes in future real primary surpluses. If you're far away from these margins where the government is going to be constrained in the future, then a current fiscal shock would typically be balanced by expectations of the future present value of real primary surpluses, and therefore would not be inflationary, as John also stressed in his opening remarks. In contrast, when the government gets close to the relevant threshold where it's likely to be constrained in the future, which could be because of political considerations or Laffer curve type elements, then it becomes worthwhile for agents to invest in getting more information about the future fiscal outlook. And then you get to a setting where inflation can become very responsive to news, in particular news about the current fiscal situation. So this perspective seems to fit particularly well the surge in inflation associated with the recent COVID shock. And it also seems to fit well the lack of inflation response to the substantial fiscal expansion that was driven by the Lehman crisis during the Great Recession, 2008 to 2009. So those are a couple strong points in favor of this fiscal approach. So a lot of John's book focuses on further extensions to incorporate sticky prices based on standard kind of new Keynesian models. I really question the usefulness of these extensions. It's certainly true that the new Keynesian model has been almost universally embraced, particularly by central bankers. That frankly doesn't mean that it's a very good model. And I doubt the reliability, particularly of the Phillips curve component, which is central to the new Keynesian model. This Phillips curve tightly links inflation positively to expected inflation and to departures of real output from trend. The question is, why should higher output relative to trend associate systematically with higher inflation? And of course, there really is no reason for that. And I don't think it's even true either theoretically or empirically. In the standard new Keynesian model, it's a focus on a situation where output employment are always demand determined. In that setting, when you get a demand shock, like an increase in aggregate demand, you get more output and employment along standard lines that looks basically like a Keynesian income multiplier. You also get that the marginal product of labor tends to fall because employment is increasing for given technology and capital stock, and it's going to imply an increase in the marginal cost of production. And that's going to tend to be met by an increase in prices as firms adjust prices in accordance with a markup type of approach. So in that setting, you tend to get that high output relative to trend associates with high inflation relative to trend, relative to expected inflation in particular. Now, of course, the structure readily admits also supply shocks. You can have shifts in productivity. And you tend to get exactly the opposite kind of pattern there. If there's an increase in productivity, or something that amounts to an increase in productivity, you tend to get higher output, but you tend to get a reduction in marginal costs, and you tend to get reductions in prices by firms that are pricing in some kind of markup fashion again. It could be immediate, or it could be a gradual process, but you tend to get that high output associates with low inflation. So of course, on net, the pattern that you would expect to see is it's going to depend on whether demand or supply shocks dominate empirically. Now, the standard model does accord well with the Volcker disinflation, which I already mentioned. You have this big monetary shock, which created a recession, and it sharply lowered actual and expected inflation. That kind of fits with the new Keynesian Phillips curve. Examples where the model fails badly is when you have oil shocks, which have been important in a number of occasions. And it doesn't work very well in the recent COVID recession, which, of course, is quite central these days. Well, I had thought of some other criticisms of John's research, but I decided to ignore these criticisms when I noted that he included me as part of this description of shoulders of giants in his slides. Then I decided I really should be nice and not go into any further negative commentary. Anyway, to finish up, I think that John's work on the fiscal theory of the price level is vastly important. He's convinced me, for example, of the importance of this work. And I think he's been contributing more than anyone else toward making this theory a core component of ideas on the determinants of inflation. Okay.
Thank you, Robert. And one of the many things I learned from your remarks is that I should always be sure to thank you and your contributions to my ideas in anything I write that you might be discussing. I'm gonna break the procedure that I had laid out earlier just to quickly read one question from the audience. We have a question from Professor Neil White at Amherst. Professor White asks, John, are you going to get FTPL vanity plates similar to Milton Friedman's license plates? So you don't need to answer that now. We don't need a firm commitment. But let me invite Eric Leeper to offer his response.
Thank you. I'm going to elaborate on a few of the things that John talked about. And the first thing I want to do is talk about how a debt-financed fiscal expansion has two distinct effects. One is that it generates higher real demand, either by the government or by individuals if it's transfers. And this is what is sometimes referred to as Keynesian hydraulics. But there's a second effect, which is that this spending was financed through government bonds. And those bonds can, in principle, increase private sector wealth. And so there can be a nominal wealth effect that comes from the fact that this spending gets financed in some way. Now, many analyses just assume that hydraulics is the whole story. So there are no additional effects from nominal debt. And we see this showing up in kind of simple ISLM models, in monetarism, in the vast majority of new Keynesian models, and I fear, as Robert suggested, also in the thinking of many central banks. And in that case, then, the sum total of the inflationary effects of fiscal policy is from the real impacts from higher government expenditures. Now, if you take that view, that hydraulics are the whole story, then if monetary policy tightens, it raises the nominal rate enough to raise the real interest rate, then it can squeeze out some of that extra demand, cool down the economy, and control inflation. But what about the debt that was issued to finance the spending? Well, what John is talking about is how inflation, both current and future inflation, adjusts to align the value of that debt with whatever it is that people expect future backing of that debt will be, that is, primary surpluses. So in this case, again, as Robert alluded to, what the Fed can do is it can affect the timing of inflation, but it can't offset it. And I might add that it can amplify the inflation too, which I think John graciously did not emphasize. So I'm going to illustrate this theory by looking at some parallels between the policies in 1933 and in 2020. So in 1933, Congress placed monetary authority in the hands of the executive branch. So Roosevelt used that authority to abandon the gold standard, revoke convertibility of dollars to gold, and reduce the gold content of the dollar. Now, there are two impacts from this that I want to emphasize. The first is that it converted government debt, which had been a claim to gold that then had to be bought with taxes, to simply a claim to dollars, which is what most of government debt is today. But the second component is that it allowed the monetary base to expand to accommodate economic activity. That kept interest rates low and stable. Now, starting in March of 2020, the Fed reacted aggressively to the COVID pandemic. It swiftly dropped the funds rate to zero, and then over the next year, it bought $3.5 trillion in assets financed through new reserves. So in both periods, monetary policy was poised to support fiscal expansion. Now, the fiscal policies in these two periods were strikingly similar. Roosevelt distinguished between what he called emergency and ordinary government expenditures. And he pledged to run emergency deficits that were financed with debt until recovery set in. And at the same time, he largely balanced the ordinary budget. Starting in March of 2020, Congress suspended its usual budget procedures to expedite getting financial relief to the public, mostly in the form of transfers to individuals and businesses, and to the tune of 20% of GDP. Now, in both periods, the modifier emergency communicated policy intentions. First, these spending increases were going to be temporary and they were going to depend on the state of the economy. And secondly, this spending was going to get financed in a way that deviated from the norm. So this graph, which is one of my favorite graphs, shows nominal debt and the debt GNP ratio in the 1930s. This vertical line marks when the US departed from the gold standard. So what you can see is a couple of things that I want to emphasize. First of all, from April of 1933 on, nominal debt doubled. But until leaving the gold standard, the debt output ratio rose. And then we left gold and it stabilized at 40%. This is exactly what you would expect from the fiscal theory. The value of debt can rise only if people believe future backing will rise. Now, in the United States, nothing guarantees debt will be fully backed. But we do have the Hamilton norm from his first report to Congress in 1790. And this is something I first learned from Tom. I like to refer to this in Old Testament terminology as deficits beget surpluses. And that was actually the first little picture that John showed. Now, most of the time, policy more or less follows this norm. And that's why US Treasuries are the world's go-to safe asset. Now, Obama said he would follow the norm. So within 5 days or 6 days of passing the stimulus package, which at that time was 5% of GDP, he said, "Today I'm pledging to cut the deficit in half by the end of my first term in office." Now, as John showed, over that period, inflation was basically flat. Roosevelt, Trump, and Biden consciously violated the norm. This quotation at the bottom is from Jen Psaki, the White House press secretary. And it says, she was referring to a subsequent bill after all the big spending bills had already passed through. And she said that this should be provided on an emergency basis, not something where it would require offsets. So I think that this quotation really accurately summarizes what the tenor of the discussion was around COVID spending and its financing. So my last picture resembles the one from the 1930s. Since COVID, federal liabilities have risen a bit over $5 trillion. Yet the value of these liabilities, as summarized by this debt GDP ratio, which is the blue line, has been declining for almost 3 years. Not coincidentally, perhaps, it peaked in April of 2020. This is the fiscal theory at work. Now, we hear a lot about anchoring monetary expectations, anchoring inflation. It's become a mantra at central banks. But we never hear anything about anchoring fiscal expectations. I think that what John's work has really brought to the fore is that fiscal expectations are at least as important as monetary expectations. And I think this carries some clear policy implications that perhaps people might want to follow up on.
Okay, thank you, Eric. Tom?
Okay, I can share my screen. Okay. So I'm just going to show a few, do a little pattern recognition, and pursue an analogy. So George Hall, my friend, and I, in almost a year ago, we published a paper in the Proceedings of the National Academy of Sciences. It's called 3 World Wars, Fiscal Monetary Consequences. We look for pattern recognition. And what I'm going to show you is another year of data. So here goes. So here's our analogy. We're from a fiscal theory point of view, or just a fiscal pattern recognition point of view. The analogy is 3 world wars, surges in people not withdrawn from the civilian labor force. So you see a first spike in, World War I, World War II, and then in COVID, you weren't put in the army, doing very little. You were paid not to work. So that's this spike, and we're gonna look at the fiscal monetary consequences of that with a few graphs. So here's a graph, kind of it's actually, you can think of it as inspired by Roberts' 1979 paper. So the blue line is government expenditures. There's World War I. You see a surge in expenditures. The red line is taxes. You see taxes rise somewhat during the war, and then they stay higher after the war. There's big deficits during the war, and then followed by a surplus for a fairly long time after the war. Here's the Depression period that Eric was focusing on, and then here's World War II, and you see kind of a big surge during the war. You actually see surpluses after the war with Harry Truman. So there's this pattern. And then now here's COVID, the war on COVID. You see this surge, and you see something different. You see surge in expenditures, and then you see that taxes after the war have stayed below. These are the new data after George and my 2022 paper that have come in. And now there's another pattern I want to alert you to. And this pattern goes back to the 19th century. What you'll see is a war, and then you'll see after the war there's a permanent increase in the level of government expenditures in the 20s. So look, you even see it in the 20s. After World War II, you see it big time, even relative to the Depression. And these are ratios to GDP. And then now the big question for us today in the fiscal theory is, are we going to see a permanent increase in government expenditures now? And if you do an eyeball, so far these data say that is looming. Here's another version of, I think of this as a barrel picture. Oops, sorry about this. These are U.S. government primary deficits. You see World War I, a surge in deficits followed by surpluses. Same thing after World War II. And now you do not see that barrel pattern, the pattern that he recommended in '79 here. You see you see persistent. Okay, so that's it. No, so what? So what? Well, John and Robert and Eric told you so what. And I don't have anything to add to that. So here's another. This is again pattern recognition. We're going to look at. We're going to take the log of price, the price level at the start of wars, and we're going to align our 3 wars. And here's what happened at the price level. George and I, influenced by John and Eric's work, we view these as consequences of the previous cracks. So here what happened to the log of the price level after the starts of World War I, World War II. So you go out and you see the price level rose. The blue line is what's been happening to COVID. And George and I published our paper here. Here's what happens since that, and you'll see this recent taming of inflation. Is this pattern going to persist, or is it going to break? We hope it breaks. Here's another pattern. What happened to the real value of a balanced portfolio of Treasury? If you held a Treasury securities invested at the start of the three wars. So here's World War I. And then this period, that's after Sir War. This period is related to Eric's table. Some things that happened in the Great Depression, and then things that Roosevelt did. Here's World War II. You'll see, oops, sorry about this. Here's World War II, and here's what's happened. Here's what's happened after COVID. So far we're more or less hugging the World War I pattern. And one thing I will say is, if you look at the 19th century, these graphs would look very different. These graphs would look very different. And fiscal theory, George and I think, is still in play, but the coordination of monetary and fiscal policy was different. So there's our pictures. One thing I'll say, this pervades John's book and Eric's work, is the way the federal government reports both interest payments and the government debt is bad accounting. And to do the accounting of the fiscal theory, you have to correct the accounts. So they do, the federal the short version is the government accounts don't mark to market, and it's quite important. So here's the par and market values of Treasury debt, and you can read what's happening. You can read what's happening during and after wars. During and after wars play down. So notice after World War I, we paid down the debt. And how did we do it? George and my paper is all about doing the accounting. Did we grow our way out? Did we inflate our way out? Did we run surpluses way out? So we do an accounting of that, and we extend it to this most recent period. And here's what's happening, that we've paid off the debt. This is Eric's fund, partly significantly by paying big time negative real interest rates. And here's another version of that. One thing is, you might say, what are these little blue lines? Well, guess what? In 2008, we started paying interest on reserves. And then in 2021, we started paying interest on reverse repos. We opened up the central bank to money market mutual funds. We extended the discount window, and that has important fiscal consequences. And then I'm going to stop here with kind of a comment and a question. So everything, all the accounting that George and I do, which is basically fiscal theory accounting, we just write the consolidated government budget constraint, and we try to do the accounting of interest payments and debt correctly. And what does correctly mean? We just take the fiscal theory and we write down the budget constraint that we're told to, and that tells you to mark to market. So we do a consolidated government budget constraint in which the central bank and the Treasury are consolidated. So now the question is, how many intertemporal government budget constraints are there? Is there one, or is there more than one? And people, early workers in the fiscal theory, Sims and Bassetto, they've written down models where they deconsolidate, and they have two government budget, one for the Treasury and one for the central bank. And that has consequences that are emerging in terms of payments, transfer payments between the two, which are kind of silenced in the fiscal theory, but active perhaps in some political economy reasons. And then there's possibly, I hate to say this, maybe there's more than two, or maybe more things are being consolidated. So if you read Bernanke's 20th Century Monetary Policy book, which he just published, the things that before 2008 were canonical rules for central banks, and what the lines between the central bank and the fiscal authority, and the lines between the central bank and many other things, they've been removed. So, one of Ben Bernanke's, he describes how the lender of last resort has been extended to institutions that weren't entitled to it. And then he talks about another concept called the buyer of last resort, where the Fed buys things or commits prospectively to buy things that it wasn't buying or wasn't supposed to buy for 2008. That has an effect on how many balance sheets there are. So, other than John, what you've done is a great intellectual and academic and public service writing this book. Thank you.
Okay, thanks very much. I think we're gonna bring everybody together on the screen, or at least that's the plan. Let's begin by John giving you the opportunity to respond to as much of that as you would like.
No, I'll be quick because I want to hear from everyone else. To Robert, thank you. I was doubly lucky. I got a chance to put in a chapter on COVID that actually made it to the final book, which you haven't gotten to see, but it's in the final book. Why this time and not 2008 is something we've all been talking about. There are the different promises. Our officials did say deficit reduction then, and they're not saying it now. And you get more stimulus out of it if you say we're not going to be doing it. But there's a second feature. The 2010s had very low negative interest costs on the debt. And as I think about the mechanism of interest costs on the debt is really one of the central mechanisms to think about here. And from my asset pricing hat, discount rates, rates of return are really important when you're thinking about present values. Robert's exactly right. The new Keynesian Phillips curve is awful for all sorts of reasons, except it's the only one we have. And why did I put it in? I have all the same problems with it Robert does, but innovate on one dimension at a time. So I put it in for rhetorical reasons. Look, you new Keynesians, you can use all your standard tools, just add fiscal theory. Now that you've seen how that works, let's get together, start with this basis, fiscal theory. Let's put in better Phillips curves. Let's put in supply shocks. Let's put in network pricing. Let's put in learning. Let's put in financial frictions. Let's put in capital frictions. Let's put in the full DSG soup. Let's put back in money and liquidity, all that stuff. This is a framework on which you can build all of those things, including, I really think we need a much better Phillips curve, and our central banks need to start thinking about supply shock. Absolutely. And this book is a foundation. It's a beginning. It's not meant as the last word about everything. Also, the Bassetto-Miller paper, the fiscal theory does point you to these run-like mechanics of inflation, especially since our governments have short-term debt. And I think that's an important lesson as well. Inflation kind of comes out of nowhere and no one seems to be able to forecast it very well. Well, the mechanics are much like those of runs. Eric's comments were wonderful, especially the difference in hydraulic static thinking and dynamic thinking. Standard thinking thinks about this year's deficit as having stimulus, whether or not it's going to be repaid. Fiscal theory is the dynamic intertemporal version. We think about debt relative to expected future repayment, even though sometimes that leads you to the same thing. Larry Summers said, here comes inflation. Why? He's thinking statically. We said, here comes inflation. We're thinking in that dynamic intertemporal version, but they're very different. They can coexist. That's another set of frictions you can add on top, but they are at heart very different. Read Eric's 1933 paper, all of you. It's a masterpiece and really opened my eyes on a lot of these issues. The gold standard was a great fiscal pre-commitment against inflation, but it had a fatal flaw in the case of deflation, where the government was committed to raise taxes to pay back a windfall to bondholders. And that's exactly what Roosevelt escaped in the 1930s. And that's exactly why I think we didn't repeat the 1930s. Nobody expected the government to pass a huge tax to pay a windfall to bondholders in the event of deflation. That was a very important one. And Eric also pointed out the brilliant idea of the Roosevelt administration to have a regular budget and an emergency budget. The regular budget is going to get paid back. Regular debt gets paid back by surpluses. Emergency debt, we're there to inflate it away, and it's not backed by future surpluses. That was so important because first, it seemed to have worked. Second, it preserved the US's ability to borrow on regular budget in 1941, when we really, if we had a reputation for we never repay our debts, in 1941, we tried to borrow and all we got was inflation, we would have lost World War II. So the preserving the ability to borrow with promises of future surpluses while also to inflate a little bit was brilliant. And that, of course, is what I think we're worried about now. As Tom pointed out, are we back to normal? Are we back? Has Washington said that was the emergency, the one-time state contingent default via inflation? Now our new debt is going to be backed. That's much less clear now than it was last time. And that's where, final comment also on Tom's stuff, there's a new Bassetto paper, Europe has 21 budget constraints. The institution of a central bank with a separate balance sheet is actually a very good pre-commitment against inflationary finance. And our legal system, our structure and institutions has exquisite systems built up against inflation. In fact, in the case of the gold standard, a little bit too strongly, because when they wanted inflation, they couldn't do it. So those institutions are good, but those institutions are also in danger. The pre-commitments against inflationary finance, the one budget constraint in our Fed, which is now a very different balance sheet than it used to be. The 21 budget constraints, or I may get the number wrong, of the European Central Bank is the central question for Europe. All of this comes down to, do we have the commitments and institutions to go back to normal or not? Thank you. That was great.
So let me begin by asking a question about these fiscal expectations that kind of keep coming up over and over again. I think it's reasonably clear where expectations about the Fed's intentions come from, right? The Fed is very clear about, since the Fed adopted an inflation target, it was very clear about what it was targeting. The Fed has, in previous historical episodes, shown a willingness to raise interest rates in order to bring inflation back down to target. Whether or not those interest rate increases actually do bring inflation back down to target, I think is a separate matter from the Fed's willingness to attempt to do that. And that's communicated to market participants. That affects their behavior, the provision of credit, things of that nature, and then that filters into the real economy and into people's expectations through subsequent downstream interest rates. We've talked a little about fiscal expectations. Eric put up a slide showing a statement by President Obama, a statement by the White House press secretary. But I think this is a component of the fiscal theory that merits additional discussion. If you were to ask me what my expectations were about fiscal policy, I would say I would expect that the debt to GDP ratio would decline because the alternative seems to me to be a kind of a catastrophic outcome. I think that, based on studying this issue, I don't know that people who are setting prices in stores, people who are negotiating for higher wages, people who are kind of living everyday economic life, really have any idea. Am I wrong about that? If not, why not? How important is that, and where do those expectations come from? That's a question for anybody who wants to take it.
Well, I've talked too much, but I'll say a few things, then invite the others. That's where, first of all, institutions come into play, and we've been talking about that. When you borrow money, how do people know you're going to pay it back? Private people, there's collateral. Governments had gold standards. Foreign debt is a way of pre-committing yourself. Our Treasury developed a good reputation. That's what the balance sheet of the central bank is. Develop the good reputation is important. The idea that people basically trust that after we've tried everything else, the U.S. will, as you mentioned, solve this problem once again. That's basically Joe and Jane sitting around thinking about their debt. Do they trust the institutions to eventually get this right? Not a specific trust. And I think people do, because it comes down to, does the average person think government debt and government money is something worth saving, holding on to, or something to be gotten rid of as quick as possible? And that's why inflation can come quickly, because people change their mind about that. Especially, Tom is reticent, but he's written most beautifully about the nature of these institutions and pre-commitments, rules and regimes for guiding people's expectations. For example, how the World War I inflations died instantly when the rule and regime was changed and people understood that their governments were going to pay back their debts.
Tom, do you want to weigh in?
Yeah. Okay. So this is going to be so I'll tell you how I think about this. Okay. And it's abstract, and it's built on Robert Barrow's 79 paper. So this is going to be his paper was simple, and it was normative. It was about a tax smoothing. It was normative. So this is kind of, so with some friends, we have a follow-up to Barrow's paper that adds a couple things. So here's what, Robert's paper took for granted that debt was risk-free, and it was going to be repaid. It was a commitment to repay, and he kind of had a very loose debt limit on it. Debt limit. Those are the ingredients. And then he worked out. He asked, what should an optimizing government do in that situation? So what we add is, we just add we take his thing and do next generation. We add the possibility of default. We allow the government to default if it wants, with consequences. And then we make the debt risky, and we allow it to hedge some of those risks by issuing different kinds of securities. And then we just redo his calculations. What does the government do? And then essentially what we get is and kind of what I'm saying is, like, this is a way of thinking about, backing up. And the question you posed was really hard. So we're going to back up in the spirit of Robert, abstract, and say, well, first thing is, what would a benevolent government that had these opportunities, that had the opportunity to default, what would it do? And essentially what happens is that the debt heads north. It heads north in a certain way. The debt GDP ratio rises, and then it asymptotes. And where does it head? Well, that depends on things. Robert depends on R minus G. It depends on the interest rate it faces, the growth rate, and it also depends on a risk premium. that it has to pay. Anyway, so what this happens, so the striking thing that happens on this, debt GDP ratios rise, and then they stabilize, they head towards something. And so the way I think about it, so calibrate this little thing to the US and see how much farther it would go. And if you do that, so that's the way we think of it about as a benchmark and kind of an empirical regularity. If you look at one country after another in Europe, countries like Belgium, various countries where the debt to GDP has risen to higher levels than the US, but then stabilized and they haven't defaulted. So you kind of ask, why haven't, so, Robert's work basically, you look at a cross section of countries and say, well, first, why did countries raise their debts so much? Why didn't they build up a war chest? Why did they go north? This kind of thing answers that. And then it says, well, why haven't they defaulted? It kind of answers that. So anyway, that's the way I think about it. Your question, I don't know. Your question, I don't know. That's how I think about it.
Let me try a certain different reaction to Mike's question. So, I've always taken very seriously Milton Friedman's famous dictum that inflation is always and everywhere a monetary phenomenon. So if you think about that after the gold standard as a serious regime, then you're talking about a relationship between quantity of paper money and the price level or path of inflation. So even in that setting, there can be a complicated dynamics in terms of how money works to affect prices. So it's not going to be that simple or obvious empirical relationship. That framework allows for sometimes money to respond a lot to fiscal developments, particularly seigniorage demands. And the German hyperinflation is a classical case where they were clearly paying for reparations expenses, especially by printing money. It still fits within the monetary quantity theory of money type approach. And you can also think about the end of the German hyperinflation, as Tom did in a famous study, where the change in the regime was very important for fixing future expectations. So then you can go from that framework where instead of thinking about the quantity of money, you can think about setting nominal interest rates, particularly short-term rates, which has become prevalent over the last decades. But it's not so different in terms of there's a dynamic where interest rates have some effect on prices and inflation over some period, and it's going to be difficult to pin down. Then I think the fiscal theory of the price level kind of supplements that thinking. And it becomes important, particularly in some circumstances. And that's a central part of the theory. The fact that it doesn't matter all the time is not a shortcoming. It's actually a central part of the analysis. And as John has stressed, there's still an important role for monetary policy, which could be captured in terms of setting nominal interest rates, particularly affects the timing of inflation in response to fiscal shocks, as in the current COVID disturbance. It's still a big challenge to think about the timing of inflation. And even more so because, as John said, expectations of future fiscal deficits are central, and exactly the way you learn about that and how they evolve is critical. And it's related to thinking about default, because it's a kind of default when you don't move the present value of future primary surpluses. You're essentially defaulting on part of the debt. And whether it's through inflation or formal default is in a way secondary. For some reason, it's supposed to be okay to default by raising the price level, but not by formally saying, I'm not going to pay. I never quite understood that, but maybe it is an important difference.
Tom sorry. John, and then I think Tom wanted to get in.
Okay, just a quick, I thought it had a little bit better answer. It is just the theory of stock prices applied to government debt. So where do people's expectations about stock prices come? Well, price is the present value of dividends. How do they know what dividends are going to be? Well, they do the best. And, fundamentally, you're arguing about rational expectations. And, yeah, people aren't rational, but people aren't clairvoyant. It's really all we think about people. People try to think about the future, and they're not really, really dumb. So that when you hit them over the head 2 or 3 times, they duck the next time. And they do the best they can, think it forward. And that's basically what we have to say about expectations, which I think is pretty reasonable.
Okay, Tom, then Eric.
Yeah, it's a follow-up to Robert's thing. So actually, and it's relevant for the fiscal theory. Actually, Germany didn't pay any reparations payments. There's a great book, American Reparations to Germany. Germany didn't pay reparations payment to anybody. Instead, Americans paid reparations to Germany in a bunch of loans that they defaulted on. So there was that big inflation. And what was the purpose of that inflation? It was to default on the domestic German debt. So essentially that inflation completely wiped out substantial domestic debt that the Germans used to finance the war. And that's the fiscal theory in big time in action.
Eric?
So I have a kind of practical view about this, which is under the maintained assumption that the Hamilton norm will be continued. What we have seen in the post-war period, and John kind of alluded to this, but he didn't get into it very much, is that as interest payments on the debt start to chew up a bigger and bigger fraction of federal spending, that's when it really bites the politicians. And that's when we get fiscal consolidation. And the problem has been that until recently, debt service has been trivial, even though debt has been elevated. And that's all changing very quickly. And so whatever your preferences are for low taxes or high spending or what have you, once you start seeing that a big chunk of your budget is going to bondholders, you start to take some action. And so I think that's one way that you can anchor the expectations, is that it is a fairly consistent pattern that when debt service gets high enough relative to spending, something happens.
I want to ask a question that kind of builds on Robert's comments to my previous question, but it's a question that I had on my mind while reading John's excellent book. The question kind of is, there are certainly periods, historical episodes where I think monetarism looks very compelling, where you can plot for, say some Latin American countries during periods of extremely high inflation, you can plot the money supply and you can plot the price index, and you see an extremely tight relationship between the two. Then you have periods like the United States has been through in recent decades where that relationship does not look very strong. The Phillips curve has been, I think, much derided over the past hour and a half or so by this panel. There are certainly periods of time where the Phillips curve is not a curve at all, and where there is no relationship between unemployment and prices. But then, of course, there are decades where the Phillips curve asserts itself, and where you do see, I think, a clear relationship. There are periods where, if instead of price inflation you have wage inflation on the y-axis, you can see a relationship. Robert suggested, and if I'm putting words in your mouth, please correct me, that that we have these different theories of inflation, and maybe they're contingent, and maybe the fiscal theory is happening at the same time that a kind of Taylor rule type inflation is happening, and the Taylor rule type inflation is dominant over any given 6 month period or 1 year period, but it's really the fiscal theory that's operating in the background, and it's kind of shaping the landscape upon which a more conventional understanding of inflation might be taking place. Is that we have these big theories of what drives inflation. We tend to think of them in competition with each other, which is the right theory, which is the wrong theory, is a perhaps a more productive way to think about it, that there are kind of these theories are all kind of operative to some degree, and which one is exerting the dominant influence is contingent on institutions, contingent on economic conditions, contingent on things like expectations, or is that a completely indefensible and crazy way to think about it?
I can lead on that. To some extent, yes, the bottom line answer, but not as much as you think. The correlations of money with inflation, they're there. How do we deal with them? Almost all of those episodes are times when governments are printing money in order to finance intractable deficits. So they are times when fiscal theory and monetary theory completely agrees. Likewise, the correlation of money with nominal income. Well, rich guys smoke cigars. Doesn't mean smoking a cigar is going to make you rich. That's completely consistent with fiscal theory determining the price level, but then people demand money, and the more inflation there is, the more they demand money. So correlation does not prove causation. The central question is whether exchanging money for bonds would cause much inflation. Episodes like that, where there was no deficit, but central bankers did something dumb. It's hard to find episodes like that. The Phillips curve is not a model. The Phillips curve is an ingredient of a model, just as fiscal theory is not a model. And it's one, as you've seen, you can put in with fiscal theory as well. For us, it's important because you need something to reflect price stickinesses. Prices do not jump overnight. So one of the reasons I use the Phillips curve is, as part of that, a standard way to sort of think about why prices move slowly. But let's not forget, I just went back and read Lucas's masterful 1972 Phillips curve. The Phillips curve was there to figure out how inflation affects output, not necessarily how interest rates affect inflation. So inflation does affect output. We need some non-neutralities there, but I think we should demote it to it and related studies. How does inflation determined somewhere else affect output and employment, not elevate it to a theory all of its own, which it is not. It's just one ingredient of theories.
So may I just pitch in that I don't actually like this game that, it's either monetary policy or it's fiscal policy that's really driving things. It's always both.
Yes.
And I think John's introduction made that pretty clear. I personally I'm not fond of the name, the fiscal theory of the price level. And I think the genesis of that name is largely a rather technical theoretical point about determinacy of equilibrium. And I don't think it's a good description of any of the models that we would call fiscal theory models. So, but we've known this since Tobin, even Friedman in his early days, it was all about monetary and fiscal policy. It was only later that it became only about M. And that's clear from Tom's work that, his classic paper with Neil Wallace is, it's all about monetary and fiscal policy interacting in a particular way to generate the equilibrium that we observe. And so I don't think there's a lot to be gained by debating whether one policy is more important than the other. We did that in the 60s with the St. Louis model. And I hope we've progressed since then.
I think the term fiscal theory of the price level is so entrenched at this point that it's better to learn to love it. And I don't think that we're going to have a switch in terms of terminology. And if you look at the COVID episode, you basically had 4 to 5 trillion in excess spending. And you pretty much had a jump in the price level. It's pretty close to a jump in the price level, which almost pays for it. And to the extent that it doesn't pay for it, that's probably still coming. But it fits remarkably well. And I would like to see more empirical work kind of across countries. This is all about the US. Of course, there's related issues for other countries. There's differences as well as similarities. I know it's not popular these days to do cross-country empirical analysis, but I would certainly like to see that in this context. I was really interested in what Tom said about there being no money printed to finance reparations in Germany. I'm pretty sympathetic with the idea that they wiped out all the real value of the existing domestic debt. Actually, in terms of thinking about the biggest macro disaster event, at least before Venezuela, was Germany at the end of the war from 44 to 46. It's a drop by over 70% in real GDP. And I tried to look at the relationship of that to various real rates of return, including government bonds and short-term instruments. And I didn't know what to do with the real return on the longer-term German government bonds, because it's basically minus 100%. It's not quite true for the short-term stuff, but for the longer term, it's basically a total wipeout of the real value, which is quite unusual in terms of the major macro disaster events that I've actually looked at. But that, I guess, fits with what Tom said about the incentive to wipe out the domestic debt.
Losing wars is bad for domestic bondholders.
Tom, did you want to say something?
Yeah, so Robert's called. There's a book by Kim Kehoe and Nicolini that does assemble for about 12 Latin American countries. It tries to do a consolidated budget, monetary fiscal arithmetic for a bunch of South American countries. Just came out last year. Yeah, so it is cross country, and it's
So let me ask another question. Robert, you commented that the kind of behavior of inflation following all the COVID spending was really a good illustration of how that theory fits the data. What would lead you all to say the fiscal theory doesn't seem to be working? It is apparently not the episode following the 2008 financial crisis, when we had large deficits and we couldn't hit the 2% target. What would it be? Any good theory should be falsifiable. What would it take to falsify this theory?
A central element in that theory, as we brought out, is these expectations of future real primary surpluses. Question is, how do you think about and quantify that factor? Because it's really central in the approach. And as you just pointed out, it's the difference that has been suggested for the recent episode versus the 2008 to 2010 period. So if one were to take on this project, for example, of thinking about the COVID experience across different countries, one of the things you'd have to quantify is what are the different expectations about the future fiscal situation? Because according to the fiscal theory, that should be central in thinking about the inflation response. And I don't know whether that works or not. And I haven't done that empirical exercise, but maybe that would start to address what you just asked.
I've thought about this a bit. Testability is hard in economics. It's fundamentally prices present value of dividends. So when do you give up on that? And the behavioralists and the rationalists have been fighting about that one for 50 years, and no one came up with a test. Monetarists versus Keynesians, they're still fighting. They've fought that one for 70 years, versus real business cycles versus new Keynesians. So unfortunately, big tests of economic theories as a class, easy tests like that don't come up. It's when it stops working as a way of thinking about events. I mean, if we routinely saw governments running steady primary surpluses, ample fiscal capacity, stable institutions, but something went wrong at the central bank and they got a big inflation, that would start to cause trouble. But also, theories need to have alternatives. You give up one theory versus another. And right now, this will sound audacious, but I think it's true. There really isn't a logically coherent alternative that is consistent with what we know about U.S. institutions. The Fed is not setting the money supply, so it's a beautiful theory. It just doesn't work with today's economy. So I think the answer is not, wait for the decisive F test, but when a alternative theory starts providing a better and more reliable account of a wide range of episodes.
Yes, Tom?
Yeah. So I give the following answer, which is in the spirit of what everybody on the panel said. Putting names aside, first, I would never give up on it. And no amount of empirical evidence would cause me to give up. And here's what I mean. Go back to Gary Becker's great, I think it's a 1951 paper. And what he did is he said, I'm going to give up completely on rationality and optimizing behavior. I'm going to have one equation, a budget constraint. I'm going to shift around a budget constraint and ask, I'm going to hold the budget constraint, and you can have any behavioral theory you want, and we get implications. I don't care. Some form of that budget constraint that John has, and Eric has, and Robert has, is it any theory? And then, as the panel's brought out really nicely, is John has courageously and cleverly added stuff to that. And it's pieces of it that you may or may not like, this Phillips curve, sticky, various things. He's added to that. You could dispense with those. Some details would change, but the essential, you cannot get rid of that control. You can change it anyway. So I would, I'm never going to give up on that, and I'm an empiricist. Okay.
So may I just add one final thing? I think this is basically completely consistent with Tom, which is the fiscal theory of the price level is just determining inflation in general equilibrium. That's it. And almost all the other theories are partial equilibrium in one way or another.
To which I would add, it is a foundation. I chose in the book to merge fiscal theory with rational expectations and a particular kind of sticky price models, because that's kind of what was sitting around and did minimal damage to what we have now. But if it's wrong, then I would start, if I'm having trouble matching episodes, then I would start with those additional ingredients. Sure, let's add learning. Let's add, somewhat irrational expectations. Let's add financial frictions. Let's add different pricing models. Those are much more likely. Those auxiliary assumptions are much more likely where we're getting into trouble than the underlying, essentially, accounting problem that real value nominal debt's got to end up being the present value of future surpluses one way or another.
Yeah. Okay, well, we could talk for a lot longer. I particularly want to ask about Japan, but I know John addresses that in the book, or at least somewhere on his website, so I won't ask about it. But I promised we would get everybody out of here at 4:30, and we're already a few minutes over that. But I do want to ask one question from the audience, because it would be a crime not to ask it, and maybe each of you could answer in 30 seconds to 1 minute. This is from a graduate student, and the graduate student asks, what are the big still open questions in monetary economics that you wish students would pursue in their research? I think with the four of you here, it would be a crime not to ask that, and to hear your answers to that. So maybe we could just go around the circle. We could start with John.
Believe it or not, does the central bank raising interest rates raise or lower inflation? If so, when and how? That, frankly, is still quite open, believe it or not.
Robert?
Well, the more general question which we've been tossing around is, what is it that determines inflation? And how do we think about both monetary and fiscal policy in that context? That's the issue we've been batting back and forth. And I think it was right to focus on that question.
Tom? Oh, Tom, sorry, you're muted.
Yeah, I'm still muted. I don't know.
Tom believes in answers. Tom believes in answers.
Tom believes in answers, not questions.
So I think what I would do is take what Robert said and add, in different institutional environments. So, how inflation gets determined in the euro area could be quite different than in the United States, which may be quite different than in a country where you can only issue foreign denominated debt.
What's a better set of monetary fiscal institutions for us to control inflation in the future and occasionally let inflation happen when it's absolutely important to do so? That's the other big. There's a lot of blah blah in the book about that, but it's just the very beginning.
Excellent. Well, that's a great note to end on. Let me again just plug the book. Be sure to purchase it. We're coming up on graduation season, and there's every reason to buy that book for any graduate, anybody who might be studying economics, and of course they have friends and neighbors who deserve a copy as well. Let me thank John. I've learned so much from you from reading the book and reading your writings over the years, and I'm so pleased to have been able to host you here today. And that's of course true for our three panelists as well. Thank you everybody for tuning into the live stream and everybody who will watch the video. And with that, we'll call it a session. Thanks so much.